All right, we are here with Stephen Carmichael, our CPA, our resident real estate taxes expert. Thanks so much for being part of our class.
Absolutely. Glad to do it.
So I ran into you, and we go to church together. We see each other all the time, but I ran into you that one day at Starbucks, I think it
Mhm.
was, and you gave me the lowdown on like how great real estate is as an investment from a tax perspective. Can you expand on that?
I can. Real estate can be an extremely valuable investment tool, especially on the tax side, because there are a lot of things you can do to take advantage of the tax code in order to save on taxes, but end up making money in the long run. And real estate's probably one of the primary drivers of that, primarily around the idea of depreciation, bonus depreciation in particular, as well as capital gains taxes, depending on how long you hold the property.
And you were really focusing on what you were doing with like Airbnbs and stuff like that. Wasn't that right? Like there were a lot of
Yeah,
investors that were doing that, and there's even additional tax benefits to doing that.
yeah, and they fall in the same category, but the requirements are different because with a long-term real estate property, let's say you own a rental house, material participation, which is what the IRS deems is whether it's treated as a business or not, the rules are different between short-term and long-term.
Okay.
So long-term rentals is anything that lasts on average over 7 days.
Okay.
Short-term rentals like Airbnbs and VRBO are 7 days or less. And at that
Why
point,
does the government do this? Why does it have that? Who cares? Why do they have that tax distinction?
because there's another rule that falls into play, and it's called real estate professional.
Okay.
The rules are very different for real estate. The I wouldn't call it a loophole, but the way the code was written in 2017 with the Tax Cuts and Jobs Act, they changed the requirements and they kind of Congress slipped it in. They kind of shoved it in. They said, "Oh, if it's a short-term rental, the requirements are different." And the IRS put out regulations in accordance with that, and it changed the rules considerably. The biggest thing is the requirements for the number of hours and how you combine if you're married for, let's say, okay, for a long-term rental to qualify for a real estate professional, you have to do more than 50% of your work in a trade or business is real estate related,
Okay.
and you have to perform over 750 hours in the year by yourself to qualify for rep status.
Okay.
For a
Do you want,
short-term
do I
rental,
want that status? Does that status help me or hurt me?
it will help you only in the sense that if you're a real estate professional, if you work in real estate, if you're a real estate realtor or something like that, mortgage brokers don't count. That's a huge thing that I found in this past year. People ran into like, oh, I sell mortgages. That's great. Doesn't count, doesn't qualify.
Okay.
But if you own, let's say, a small fleet of properties, let's say anywhere from between 5 to 20,
Okay.
which does happen. If you're a real estate professional, all those buildings and all the real estate income and or loss count as active. So if you're, let's say you're married, you're a real estate professional and your wife or husband is a W-2 earner.
Yeah.
Their W-2 income is treated as active. If you're a real estate professional, if you have a lot of real estate losses, which you can pick up from depreciation expense, which we'll cover in a few minutes,
Yeah.
those are also treated as active. So it offsets your W-2 income.
Why does the government give this such benefit? Like, why does the government love real estate as opposed to like mutual funds? Why don't they give you all these great advantages if you're trading securities as opposed to real estate?
Because the one of the biggest drivers of the economy overall is real estate. People buy it. Invest. If you look around town, you'll see car washes pop up all the time.
Mhm.
That's a very large driver of the economy. It keeps money changing hands, keeps the economy moving. The reason people buy car washes is because you can expense and depreciate 85% of the purchase in one shot. You get that bonus depreciation expense on your tax form. You take an active loss and you sell it the next year or
Okay,
within 2 years.
so
That's
let's
why they
say
change hands all the time.
let's say that I build a car wash that's $1 million
Hmm.
and I sell it within 2 years. Are you telling me that I could write off $850,000 in losses because it's all in one
In
shot?
the
Is that what
first
that
year.
means?
Yeah, because what's going to happen is in the first year, you can take a massive loss as long as you materially participated. But that's different. That's business. So the
Yeah.
requirements are slightly different. I'll cover that in a minute. But yeah, you can take a really big depreciation. On paper, it's a loss. In reality, you're making money because cash is flowing through.
Right.
But the depreciation expense, which is a non-cash expense, eats up all your profits. So your books go, I had a massive loss this year. It eats up any other income you had. You end up paying no taxes that year.
So essentially the whole point of that is so that I don't have to pay any taxes. And so year one, I do that, I sell it, I take that loss. Year two, I buy another car wash. I do the same thing. I don't pay any taxes, even though I'm making money on the car wash. I can continue to do this over and over and over again and pay no taxes. How is that legal, Stephen? How is
It
that?
is a beautiful thing about they never thought of the consequences, because what you're happening if you do that. Now, there's a caveat to that. It's called the 1031 exchange.
Right.
So you can and it only works on real estate. It used to be you could, real like kind exchange between cars and other equipment. Not anymore. It's just real estate and real estate adjacent, like so land and buildings.
Okay.
The cool thing is you can 1031 just daisy chain down the road. Our local favorite Hillwood, one of the Ross Pro companies, does that all the time. They're constantly 1031ing into new stuff. There's another piece that goes to that is whenever you 1031, you have to go bigger. You can't go smaller.
Right.
Because if you go smaller, you pick up the difference in loan. So let's say you have a $500,000 loan on one property and you step down to a $400,000 loan on the new one. That $100,000 swing, the shrinkage is picked up as what's called BOOT, so taxable income.
Yeah. So this isn't fair. Mr. Simpson, the teacher, works 40 hours a week and gets crushed by taxes. Mr. Simpson, the real estate investor, can go 1031 exchange, can go buy car washes and expense the losses and pay no taxes. What kind of system are we in here, Stephen? This just doesn't seem right.
Is it fair to every investor? No. But the amount of work it requires and the amount of capital it takes is substantial. And that's why not everybody can take advantage of. But most people don't know these rules.
Right. Right.
And most people are go out and buy it 27.5 year exchange, depreciate over time, and don't take advantage of the code like we do.
Right. Which is like we're letting the genie out of the bottle right now. I mean, we're like letting the students know that like the secrets to the wonderful, I mean, like I think one of the best, we're reading Rich Dad Poor Dad, and he talks all about this over and over and over again, the write-offs, the 1031 exchanges, all of those kinds of benefits. And it feels like that's something that a lot of people could potentially know, but I don't know. We just put our head down, we go do our job, we go buy we invest, we do our 401k matching, which is fantastic. We go do our Roth IRA, we buy our Robinhood stocks, and we just sort of keep our head down instead of saying, man, like I talk about in my class a lot, like the worker gets 3 outs per inning, and the investor we're talking about here feels like they get 12 outs per inning. They just get an unfair advantage.
It sounds like it's unfair, but think about it in this sense. The ones who put the money in are the ones who accept the risk. If there's a bad chance, if they buy a house, let's say for $500,000, the market tanks and you lose $300,000 in value, they're the ones who take the loss on that. They're the ones who take the hit, and you don't recognize that loss until you sell it. So, you invest $500,000 in a property, put another $100,000 of upgrades into it. They're the ones who made the risk. They're the ones who reap the reward, and that's what most people miss.
I bought all my rental properties. I mean, I know that there's a risk involved with it, but my tenants have paid my mortgage for me for 20 years. I mean, yeah, I mean, there's a risk, but someone else is paying, as long as they're paying their rent every month. To me, like that risk has been shared with fellow tenants or tenants that are in those properties.
Except that it's not, because you're the one holding the mortgage. That's the difference. You are the one on the hook for it. So the idea is high risk, high reward. You put your money where your mouth is, and you put at risk in.
But it doesn't. But I'm not trying to argue with you. I just feel like I haven't had to risk that much. Like to me, I've like people need a place to live, and as long as my mortgage has been covered, yeah, the air conditioner goes out, and yeah, the foundation has an issue, and it's $15,000 or whatever. But I'm sitting on 3 properties that are completely paid off, all because my tenants did it for me. And I got to reap all the rewards of all of these tax advantages. It just feels like, I don't know. It feels like high reward with low risk.
In your case, it was, but I've worked with so many people who own rental properties who lose money every year and never make a dime, even from cash flow standpoint. Like they're not charging enough rent and they end up losing money because they're not as savvy as you were. The education thing is, but it plays a part because people go into it thinking, oh, this is going to be so simple. The tenants are going to pay my mortgage. Depends on where you put the properties and where you buy them at too. Because if you're smart about it, do your research before you just go buy a house.
Yeah.
Yeah, you'll do fine. You'd be amazed at how many people lose their shirt on rental property and take it, and have foreclosed on because they didn't do their due diligence beforehand.
I think I've lost more in the stock market than I have in,
Most people
I've
have.
lost more in
That
crypto
is
than I have,
very, that is absolutely the case. And that's most cases.
Yeah.
I had a gentleman last year who did the same thing. He lost a small fortune on the stock market, but he made a boatload selling a real estate property. So
Right.
it offsets. But that's the thing. It's the high risk, high reward. And it's, let's be honest with ourselves. Crypto is not the most secure. It's not secured at all.
It's a lot of
Kind
fun.
of it is a little fun to mess with. I've dabbled in it a bit, but I don't have that much money to play with, so I don't mess with it too much. But yeah, the whole idea behind the tax code in general, and this is across the board, if you put the money in and you take the risk, you're the one who's going to reap the reward. Business owners are the same way. They're the ones who put up the starting capital and put all the sweat equity in. And people are like, well, they're making so much money. Yeah, because they put the work in and they put the money in.
And I'll tell
They
you what,
took the
Stephen,
risk.
I've just learned about wholesaling. I mean, I should have been buying more properties that way, but like
Yeah.
one of my friends turned me on to Trelly, which is an interesting site, which basically gives me properties that are coming on the market that are, 70% of their actual value or 60% of their actual value, but they're distressed. They need $15,000-$20,000 of TLC put into them, but you buy them and you get instant equity. I mean, you don't even have to pay mortgage insurance.
Oh, yeah.
But because I have a credit line, I can go buy the property with cash with my credit line, and then turn around and turn that credit line into a loan within the bank, and cash the credit line out and just have a secured and have renters there. As the market starts to come down more and more, I'm starting to get more and more of these wholesalers who are reaching out to me with people who are distressed properties or trying to get out of the property. So I feel like, I don't know, I feel like my students, if they could go the investing route into real estate, yes, they may lose some money here and there, but overall learning as they go and continuing that investment, I don't know. Other than matching 401k in a Roth IRA, I think real estate might be the best thing there as well. But let's take a look here, like write-offs. Why is this such a massive advantage to a real estate, to a landlord?
Because ultimately the goal is to not report income. I mean, on paper.
Are you serious? Who's going to pay the teachers? If we don't have income, if we don't pay taxes, who pays Mr. Simpson, the teacher?
Oh, you're gonna get your tax bill regardless, because everybody from around here pays on property taxes, so there's no avoiding that. The good thing is, this is at the federal level. You're looking at the state and local. That's different. That's a whole different issue. State and local taxes are handled very differently, and that's varied between localities, counties, states, the whole thing. Those are all different.
Right.
This is all primarily from a federal standpoint, from the IRS. So the federal government, the tax code is immense in so many ways, and there's so many different regulations and so many rules and so many things you have to deal with. The cool thing is you can take advantage of it to your advantage. Everybody says, oh, it's a tax loophole. It's not a loophole. The tax code was written in a certain way to allow for certain interactions, and that's where people think it's a loophole. It's not. The way the code was written was made, let's be fair, it was advantageous to more people who have the money to start with, but you can take advantage of it even if you don't.
Right.
The biggest thing is write-offs, like you have written on here. You've got repairs and maintenance, marketing, advertising, travel, mortgage interest, management fees, depreciation being the biggest one. There are other things you're forgetting, utility costs. So if not every mortgage is triple net where the tenant pays for everything.
Right.
And sometimes if you're depending on the property, if it's in a distressed area, you'll pay the mortgage insurance, you'll pay the insurance. Those are all deductible. Everything that you put into this thing is deductible in some form or fashion. Repairs and maintenance, you pay for a cleaning service to come in, especially on short-term rentals. Let's say, I have a lady who comes in my house every 2 weeks and cleans. That's a fee I can write off. Anything that you put toward
and we have that, Stephen. We have that in our house, and we write that off in our business because my wife works out of the house with her business, and I run the real estate out of the house. So we get that portion of our house as deductible, and we get our house cleaned. Like that just doesn't seem fair. Mr.
It
Simpson,
is
the teacher,
because
Mr.
you're
Simpson, the teacher can't write the house cleaning off. Mr.
no,
Simpson, the real estate investor who isn't even renting out the house that he's cleaning, gets to write that off.
because the IRS treats it as a business. It is
Right.
ultimately it is reported on a different schedule. It's not Schedule C, it's Schedule E, but it's still treated as a business, especially for if you're in real estate. If you do enough hours of working in real estate work, and it goes into the whole treating it as active. So a lot of times, you people that I've got guys who are like, I have a plan on bidding 15 houses and doing nothing but real estate. Okay, then great. You're going to qualify for a rep status and you can write off everything as active. So if
Right.
your spouse works and earns active income or has her own business, it offsets.
Yeah.
So that's where a lot of it comes in. And people don't realize just because it's an expense on the tax return doesn't mean you spent money. And
Yeah.
that's where the biggest savings are, is from that non-cash expense.
Which is amazing, which is what I love. I mean, it's when my accountant showed me last year what we paid in taxes. I mean, I can't believe it how little I pay compared to Mr. Simpson, the teacher. It just
Mm-hmm.
doesn't seem fair. But then again, we're not talking about fair. We're talking about like the government. I think the government sort of likes me to have properties so that I can. I mean, people need a place to live, and if there's people willing to take the risk to have rental properties, then that's. I mean, I also provide jobs within my sports camp business, so that also
Yep.
gives me a ton of write-offs too. Which it just, I don't know. We teach our students, go to school, get good grades, get a good job, get your 401k, and that's that. And I think we really need to be thinking about what are these other avenues of income, because like multiple streams of income are really important, because if your job goes away or whatever, you need to have different ways. But the depreciation, this doesn't
Mm-hmm.
make any sense to me at all, Stephen. Here you have a property that I bought one of my properties in Keller for $87,000. It's now worth $320,000, right? But the IRS says that I get to depreciate the price of it, even though it has appreciated in value. Explain that.
Because what you're doing with depreciation is you're taking an asset, in this case, a house, and you are spreading the cost over its use, what the IRS calls its useful life. So for real estate properties, it's 27 and a half year. If it's commercial, it's 39 year. And you're taking that cost and basically you're spreading it out, because the IRS doesn't want you to be able to just expense the entire thing in one shot and take a massive loss.
Yeah.
So you take the cost of $100,000 and you spread it out over time, like this way. So it goes down, and then you'll pick it up on the back end when you sell it, because you net the value. So you pay $150,000 for the house, you've depreciated $100,000, and you can't depreciate land, so you make sure you separate that out as a separate piece on your books,
Yeah.
and then you sell it for $300,000. Okay, well, your value, the difference between what you sold it for and what you bought it for, net of depreciation, you pay tax on that gain.
Yeah.
So
I
that's
mean,
where they get you.
unless you 1031, which we'll talk about in a minute, and then
Mhm.
you don't pay it anyway.
Oh,
But
you do down the road though.
right. I mean,
Yeah.
at some point, but like it seems like what a lot of people do is just they roll it over and over and over and just never seem to, they never get called on that debt. But but you said that the depreciation for like my rental property, I can depreciate it over time. But if it's an Airbnb less than 7 days, I can depreciate all at once. Is that
No. When you're doing that, that falls under the bonus depreciation rules, and that
bonus?
is also utilizing a cost segregation. Now, the
Okay.
bonus depreciation up until December 31st of this year, anything that has an asset useful life of 20 years or shorter, you can expense 100% in year one.
Okay.
After this year, at least for right now, unless Congress re-ups it, it drops to 80%. So 2023 is 80, then it drops to 60, then 40, then 20, then it goes away
So an asset
completely.
that has a life of less than 20 years, you can expense it all in 1 year. So a car wash, people are saying, is not going to exist after 20 years. It just isn't going to last that long. What other types of things out there are
Uh,
something they would?
oh goodness, appliances, fixtures, blinds, interior electrical work. They will go in, and I've got cost segregations that are 60 pages long,
Wow.
breaking out every little individual piece because it adds up. The idea
Right.
is the walls, the wood, the roof, that's all 27 and a half year property.
Yeah.
But everything that makes up the rest of the house can be broken out into different pieces. And the biggest things being furniture, fixtures, and appliances. Those are the three big categories where you can really expense a lot in one shot.
Yeah, and car washes. I mean, that's incredible. Like, and I think I mean, we're looking right now at Trump and some of the things that some of his losses he's had or whatever over the years, and he's had like literally like rolled over losses over several years to show he just never made a gain, which thus and which is totally okay within the tax code. So like, you know what I mean? So it's like there are ways to essentially roll over losses to never have to pay taxes, right?
They carry forward. Yeah. So losses carry forward indefinitely. So Trump, if you look at his history, he had billions of losses back in the mid to early 80s. He does not do so great, but a lot of that's on paper. And everybody's like, oh, it's loopholes. No, it still goes to a lot of it's depreciation because he was a real estate investor. He did a lot of real estate development. All those losses just keep perpetuating every time he built a new building. Massive losses.
Yeah.
He'd take the bonus depreciation. Apartment buildings, things like that are really, really good for that, especially for investors. We can talk about that in a few minutes.
Right, because they
But
got a
that's what he
million
did. He just
mini
basically
blinds and refrigerators and all the things you have to put into an
Mhm.
apartment complex. You get to write all of that off in the first year because they're all less than 20-year assets.
Right. At least for right now. Bonus depreciation didn't really become a thing until about 15 years ago. But
Okay.
the thing is, that's what happens. Once you have a massive loss, if you don't have income everywhere else to offset it, they just carry forward. Because if it's passive, but he's a real estate, so he got to treat it as active, so he could take all the losses in 1 year. But anything he didn't use carries forward indefinitely. So he just kept building up and building up and building up his losses, and he continues to use them. Everybody's like, "Oh, it's horrible." No, that's what the tax law is written for.
Right,
He's an
right.
extreme example, but
Yeah,
that's
yeah,
exactly the whole point. Like, you don't think Ross Perot, George Soros, all these really high net worth guys, they all
right.
utilize it. Everybody utilizes it, but you always hear about oh, and I'm not going to get political on this, but you hear like all
Yeah,
these rich people didn't pay taxes. It's because they took massive hits back in the back and they're just carrying them forward, and that's what
yeah.
people don't realize.
Interesting. And so pass-through deduction. So I have an LLC. I formed an LLC for every one of my houses. My accountant and my attorney both told me to do that. And my sports camp business has an LLC. Sorry. What is the point of an LLC? Why is this pass-through deduction so important?
Pass through is not a deduction. Pass through, what it means is the business entity itself does not pay the taxes. It passes through to the individual owners. I am not a lawyer, cannot speak as one, but an LLC is primarily designed for asset protection to keep you and corporate veil separate. So that way, something happens at your house, people can go after the business and not go after your house, your personal stuff.
Right.
But the difference is like an LLC, if you own the LLC and you pass it through, if it's treated as a partnership, you pay self-employment tax. S corporations are taxed similarly but different. An S corporation, once you make that election, you are still a shareholder, but you also become an employee. You have to run payroll to stay current and in line with the regulations required. But the cool thing is, the employment taxes that you would pay also get deducted at the business, which ultimately reduces your business taxable income on your 1040. But also, you don't pay self-employment tax, which is a huge, huge
Yeah.
win.
And that's my accountant and my attorney. And by the way, what you're telling me is making my head kind of hurt. It's just a lot of, I mean, I'm a B- student, Stephen. Like I can get some of this stuff, but honestly, like I need people way smarter than me to point me in the right direction. At the moment we paid off our rental properties and the bank would not allow my LLCs to be held in an LLC until I paid them off completely. And so once I did, my attorney's like, you've got to move those into LLCs for the corporate veil, like you said, for protection and all that stuff, which was great. Like, and we'll talk about this more with my students, forming a corporation for their businesses as well. Let's move on here to tax advantage of capital gains. What is this?
Capital gains are taxed very
Sorry,
differently.
we're
So,
oh, go ahead. Sorry, the bell
okay,
rang again.
that's fine. Yeah, capital gains are basically how much money you actually made from your investment. Now, the kicker is short-term versus long-term. Yeah, I see on the slide right here, you got short-term results if it's owned for a year or less. However, they are also taxed as ordinary income. So if you make a lot of money in your W-2 and you have short-term cap gains, they get taxed at that high rate.
Okay.
Long-term is much more favorable. They want you to hold it longer. So you do get much better rates, anywhere between zero, where capital gains aren't taxed at all, versus up to, I think the highest rate is 20 to 25, but that's on really high end earners.
Okay.
So it is, the idea is they want you to invest and hold it. They don't want you to just like a quick flip.
Okay. Right. Yeah. And so like if I buy a piece of property and I put $20,000 into it, I bought it for 80,000, I sell it for 200,000, I have to pay. If I sell it immediately, if I flip it, then I'm on a short-term capital gains. Whereas if I buy the property for 80,000 and it's worth 200,000, but I hold it and I rent it, I get long-term capital gains. Is that correct?
Yes, that is correct. So basically the idea is anything you hold longer than a year, you can get favorable tax benefits from, especially if you're, depending if you're, how much your W-2 is or whatever else other income, active income you have, it would keep the tax rate potentially at zero. So you could make a huge amount of money and you may only pay 15% in tax, whereas your normal rate may be 32 or 35.
Gotcha. Okay. So the 1031 exchange, obviously Rich Dad, Poor Dad, probably one of the favorite things he loves to talk about. Explain this, what this means.
The idea is basically you buy a property, you hold it forever long, and then you want to buy a new one, but you don't want to pay capital gains on the old one. So what Section 1031 allowed you to do is basically trade. So and you have to use a qualified intermediary to do it. You can't just go out and do this. Oh, I'm going to go to 1031. There has to be a qualified intermediary, and there are companies out there that specialize in this. Basically, what happens is you sell your old property, they take all of the net proceeds from the sale and they hold it for you in escrow. And then you go identify another property, and there's a timeline of times you have to follow. You have to do it in a certain amount of time. And then you go buy the new property. The kicker is you don't pay tax on that. But however, the tax basis in your new property will be reduced by the gain that you picked up on the old one. So ultimately, like let's say because you're not skirting taxes, you're deferring them. So you will pay tax, you will pay the piper eventually. But if you keep 1031ing it, that gain just keeps building up. So you can 1031 into a bigger property that has a higher mortgage and not pay any tax on, let's say you sell a property, you make $200,000 in gain because you bought in a great area and it appreciated really quickly. You can turn around and 1031 that, and your basis maybe $500,000. You pay $500,000 of basis in the new one, but that $200,000 gain you picked up on the old one is going to reduce that $500,000 basis down to $300,000. Okay. So ultimately, when you sell it at a higher rate, when you sell it for a gain, that's when you pick up the difference because your basis was reduced from $500,000 to $300,000. You sell it for $700,000, you're going to pay a $400,000 gain versus $200,000.
What happens if I never, with the example of these three properties, let's say I do this and then I do this one and then I move into this commercial rental. Let's say I never sell the commercial rental and I pass it down to my kids as an inheritance. When is the taxes actually ever paid?
Not until it's sold.
Okay, so
if it's held,
let's say Henry takes control. Henry is the property manager that's taking control of it or whatever, and he decides we just want to keep getting income from this property. We never want to sell it. As long as you never sell it, like you never gonna pay tax on that,
right? And that's any asset. So anytime, even if a partner, like in a partnership, let's say it's two guys and they have a partnership and one leaves, and he takes an asset with him, he will not pay tax on that until he sells it. So if he never sells it, if he just holds on to it forever, tax never get paid.
Man, that's awesome. Because really, you're basically this commercial property right here is like having an ATM machine in your house, and it's just spitting out cash every month. Of course, there's maintenance on it. There's some things, whatever, but like, why would you ever sell it? Like, you're just getting passive income from it every single month. I don't know. That's amazing.
A lot of times people will do it because they, if they want to move out of the area, don't want to worry about managing it. But also a lot of times because most of the time it's because people see a massive opportunity to get a massive gain on a sale, and they'll just go ahead and dump it. That happens. But for the most part, yeah, and the thing is, especially with inheritance, you get stepped up basis. So that's a whole nother issue that plays into it because, you may have bought the house and have, $100,000 basis in it. The minute you die and your kid inherits it, whatever the value was at the time you passed and it changed hands. So let's say you bought a property for $87,000 as basis of zero. You get hit by a bus and then Henry picks it up and it was worth $300,000 when you died. his basis becomes $300,000.
Wow. Oh my gosh. So it goes from 300,000 to 400,000. He only pays taxes on the 100,000.
Correct.
Steven, this is amazing. Real estate is awesome.
It is
Students, buy
fantastic.
rental properties. Golly, this is I didn't even know that. That's just that my brain just can't fill all this information. All right, opportunity zones. What is this about?
That was created by the Tax Cuts and Jobs Act. It's basically a way for people to like buy property in very distressed areas that they, locals want people to invest in to, because there's some really good tax advantages. Same kind of idea of a 1031 where you can basically, you have a lot of gain you picked up from something else. You can put all that gain into an opportunity zone, and there's some additional requirements you have to meet in order to keep that, because otherwise they pick you up as gain whenever you do if you miss a reporting period.
Yeah.
But basically it was a way of getting people to invest their gains and, hey, we'll give you a break on your taxes right now, you can pay it later.
Yeah.
But this way it puts the money into an area that's distressed and needs to be revitalized. That was the whole idea behind it.
Just a real sketchy area that's got maybe crime and all sorts of things, and so you go and buy a rental property, and and it like that area. Interesting. I mean, that is a good way for an area to, I don't know, get a facelift to some degree, and maybe even be revitalized. Some of these downtown areas, like I know in San Diego, or even like, when you see movies based in New York City in the 1970s, and then you see New York City now, you're like, oh my gosh, it looks like a war zone there, and it looks like Disneyland over here. Just like the ability to put money into areas that are distressed. That just sounds like a good thing for investors, good thing for the area. Let's look at this last thing here: the self-employment without FICA tax. What is this? What does this mean?
Okay. Self-employment means you are active and materially participating in a trade or business.
Yeah.
The idea is, okay, so if you're an employee, if you look at your pay stub, you have Social Security and Medicare. What you don't see on your pay stub is the business is also paying Social Security and Medicare because it's split between the two of you.
Right.
Self-employment is when you are your own boss. You are the business owner, so you're actually paying both sides of it. You're paying Social Security and Medicare for the employee, you, and the employer, also you. So that's why a lot of times it hurts for self-employment, because you're paying both sides, and it picks up on your W-2, on your 1040. So you pay a fortune, massive amounts of taxes, and it's not deductible to business. That's what makes it worse, because it's not a deduction you get to take and lower your business income as you would if you were an S corporation or even a C corp. So
as a real estate, as a landlord, because it's passive income, you don't have to pay this self-employment taxes.
Correct. Yeah, that's the nice thing.
This is fantastic. This is great.
And that's the fun thing about real estate, because you can flip back and forth. So even if you're a real estate professional and you get to treat your losses in real estate as active, it's still not subject to self-employment. That's where the biggest driver is. Now, short-term rentals are a different animal. They are treated not as Schedule E, they are treated on Schedule C, like a regular business. So those would be subject to self-employment. But the cool thing is, because of the bonus depreciation rules, you only want to do that in year one. You're going to have massive losses in year one you can treat as active. And then as soon as year one is over, you can flip the switch and make it a long, basically still treat it as short term, but you don't care if you materially participate anymore because you've already gotten that bonus out of it. So you can report it as passive losses on Schedule E, and ta-da, you never have to worry about it again. And there's no self-employment either way.
Steven, man, you've been fantastic. Thank you so much for all the information. And this really helps my brain. This tax code stuff, I hire people to do this because I don't know, I understand it. Thanks so much for being part of our class.
Absolutely. And I would be glad to do it anytime you need me.